Hey guys, so today we're gonna be starting off with what is it called? Tis called acquisition of control. So we're just gonna go over some things about that. So to begin, let's start off with corporations and taxes. Okay, so some basic stuff. So first of all, we have, I'm not sure what this is supposed to mean, but we have this, what? Why is this thing? Okay, there we go. We have this primary like relationship maybe, and then versus secondary relationship, I guess. So basically, I don't know if I have to go over this. Whatever. In terms of primary people, those primary people would get dividends. Like people have a primary relationship with a corporation, they would get dividends, so they're like a shareholder. Whereas people who are secondary like relationships, they have like a secondary level of relationship with the company, I guess. They get paid salaries and stuff like that. So for this secondary level, there is only one level of tax that is being applied. So if you see on like, if you look at like a company's income statement, what you have over here is we have revenue, they have expenses, and one of those expenses is salary, and this sort of reduces their net income, so it goes down. And you might be like, okay, so this salary isn't like paid, like nobody pays taxes on this. Well, no, on like a human person's income, well, not income statement, but on their tax return, they've got their employment income, and that's where the salary would go. So basically, it's not taxed here because it's taxed here. So there's only one level of tax. The human person pays it. Okay, it's paid by the employee. On the other hand, we have this primary relationship, and for dividends, what this happens is on the companies. So I went over this sort of in detail in another video. But basically, for a company's income statement, you got your revenues, you have got your expenses, and that gives you net income. And thing is, the dividends that you pay out is kind of like after the whole expenses. Like the dividends isn't counted as expenses. So whatever you dividends you pay out, you actually pay tax on that. Okay? So like the dividends, the fact that you're paying out this money to like your people doesn't really reduce your income, so you're paying tax on that. And another thing, the other like the basically there's the second level of tax is on a human person, humans their tax return. They've got their dividend income of like this amount. So basically it's being taxed over here and it's also being taxed over here. So there's like two levels of tax. This is just like a little bit of introduction on primary versus secondary relationships? People? I don't know. But that's enough of that. Right now we're going to go to the meat of the thing. It's called acquisition of control. So basically, this is when a corporation decides to buy 50% or more, or is it more than 55? 50%. 50% or more of another company's like um like shares, I guess. And they're it's like sort of like a non-related transactions. Like it's all third parties. Like it's two non-related, not related companies, okay? And you might be, and thing is, there are some rules for sort of how you can report assets and liabilities once you sort of, like capture all this stuff. Like, for example, let's say, okay, like first, let's say I am company A and I've got like all this income, right? I hate this marker. And then I have company B, then I have this net income. And let's say that I'm like, I want to buy like, I don't know, 60%, 60% of company B. So like I do that. And so all of their assets, like, I don't know, cash, AR, inventory, how would these be reported on my income statement? Would it be like literally the same? Like, would it literally, if cash was $36 there, would it be 36 here? If inventory was $40 here, would it be $40 here? And that is basically the gist of this acquisition of control rules, in addition to a couple of other sort of like restrictions that there is. Like, for example, one thing is if inventory is $40 here, it doesn't mean that it has to be $40 here, because there might be like fair value changes and stuff like that, which we'll be going over. So to begin, one reason why they have this sort of like rule thing set up is because what happened is you've got this company over here and this guy's got like a negative income, so they're like losing money. They've got like a whole bunch of losses. And then you got this guy over here who's got like lots of money, so they're paying, so they've got like a lot of like gains and stuff like that. And they're paying a lot of taxes. Their taxes are high. these guys are not paying any taxes, 0 taxes, or even like, what's that thing? You can like push taxes. I think there's like a tax deferral thing where you can like push it to like later years or like prior years, whatever. But we've got these 2 different companies, and what they could do is they could sort of join. They join and they become BFFs, and basically this I'm gonna name this guy A and this guy B because A is sort of like the leader of the troop. Basically, this guy decides to buy B in order to lose B's losses. This guy's like, oh my god, if we buy B, all of his assets will be ours, but all of his losses will also be ours. So we can use those to basically reduce any gains that we have and reduce the taxes that we have, and we pay 0 tax. And they're like, mwahaha. But the government's like, no, we're not gonna let you guys do that. That's kind of, well, you know, where are we supposed to get our money from? Which is why we've got these rules for acquisition of control. AOC is a acronym for acquisition of control. The basic sort of, okay, so just to recap, acquisition of control is basically when a third-party buyer, whether it's a human or like another corporation, buys some other company, okay? And it's like, how should I report their stuff on my, can I use their losses? What's sort of like the rules I can use? And also, how do I report their, I don't know, like their assets on mine? Not really how can I report it, I guess, but like, can I claim losses on those, or can I claim gains on those? Okay, so the basic gist for like most of the things over here, the thing about AOC, the rules come down to the fact that we just want to write down everything that we have to the fair market value. And if there are any like losses that occur in that process, then it's either like a capital loss, a business loss, blah blah blah, whatever. Okay, so let's start off with like a basic, just like a sort of like the first rule of acquisition of control is that there's going to be a deemed year end the day before. So basically, if I am company A, right? I don't know if I could draw this out. Let's say the date right now is December 1, December 1, and A buys B, right? And this is like this is like an acquisition of control. Like it's been like verified, not verified, but it's like it's an acquisition of control. Like it's got all the conditions met. That means that there's going to be like a deemed last date, what's the word? Year end, deemed year end on the day before. So basically November 30. November 30 is basically like the year end for I think company B. It's sort of as if company B, when A bought company B, it's sort of like company B just stopped existing, or it's like cut it off at its legs right there. So we're sort of like cutting it off right there. And that's just the first thing. There's gonna be like a deemed year end, and that I guess that year end sort of like used just to like clean stuff up, you know, organize it so they know like to pay all the taxes and stuff like that. The second rule, oh my, sorry, 8 minutes. Second rule relates to 4 different types of properties. So there's inventory, AR, depreciable property, and non-depreciable property, all of which have different sort of like rules on how to account for them and stuff like that. So to begin, let's start off with accounts receivable. Let's start off with inventory. So inventory will use the LCNRV rule, so the lower of cost and net realizable value. So basically, inventory, it's recorded on the balance sheet at cost, but if we find out that the net realizable value is less than that cost, then there's going to be a loss that's going to be recognized, and this loss is going to be like a business loss, which is a non-capital loss. So to do a little example, let's say we've got this inventory, it's got a cost of like 60K, the fair value is 50K. What this means is that on the balance sheet it's listed at 60K, but in real life if I were to sell it, I would only get 50K back. So that's sort of like a little mismatch, and it would be sort of wrong to write it down as $60,000 on my new balance sheet, like on A's balance sheet. So what we're going to do is we're going to reduce the cost to the fair value of 50K, and we're going to recognize a loss of 10K, so the difference between these two things. Okay? Is that it? Oh, that's it. Basically, yeah, and this loss of 10K is going to be a business loss, so it's going to be in section 3D, and this is a non-capital loss. Non-capital loss. Okay, so that's Inventory. Inventory. So next, let's look at accounts receivable. So for accounts receivable, one thing is you can't actually, you know how usually accounts receivable, we have like an AR account, and then we have less ADA, the account for doubtful accounts, also known as the reserve for bad debts. Just sort of like the contra account for accounts receivable. One thing is when you move this AR to A's balance sheet, when you like move it over, because I bought B and I have like their accounts receivable, I'm moving it over. I can't move over the ADA. That's not allowed. So what I would have to do is that I have to go into this AR account, examine each sort of, I guess, like account receivable sort of like, I don't know, people that I have, I guess, and claim it. And if I find out that any of the account receivables will not be collected, I will claim those as bad debt expense. And bad debt expense, as you know, will go into like, net income and all that stuff, and it'll reduce our business income. So that's like, sort of goes into like business loss, so it also goes into non-capital loss. Oh my god, I didn't even talk about that stuff. Okay, whatever. Talk about it later. So as an example here, we have this AR account of 50K. We find out that about $10,000, 10,000 of that is non-collectible. So we're going to record a bad debt expense of 10K. And we're also going to, oh my god, we're going to do this? Oh, yes, yes. Will we? Expense. I think so, yeah. Okay. We're also going to reduce the AR balance to $40,000. So like on our balance sheet, instead of it being at 50K, it's going to be at 40K. Basically, it's just that every time we want to be showing it as the fair market value, sort of ish. So we want to get rid of all the money that we can't collect, or all the money that's sort of like lost or whatever from a loss. Okay, that is that. Well, there was something that I was like, damn, I have to go over it. All right, yeah, so non-capital versus net capital loss. Okay, so the one thing about acquisition of control is that net capital losses are denied. They're just like, no. Okay, so if I get any loss that's a net capital loss, so net capital loss is literally just 3B, section 3B. So if you have a capital loss, a capital gain, and you have a capital loss, what is the net of this stuff? So like the gain minus the loss. If it's like a negative number, then you've got a net capital loss. Like there's a bit more, like a bit of math, like, the capital loss can only be as much as a capital gain. Basically the difference between these two would be the net capital loss. So that is net capital loss. And on the other hand, we have non-capital loss, which is every other loss that's not a capital loss. Okay? So this could be like business loss. Is also property loss? Because remember we used to about how property loss was denied? I'm not too sure. Let me quickly go over that stuff. Um, yeah. Net capital losses, property losses, and ABLEs expire, which kind of sucks. Like a lot of things expire. Like basically, alright, okay. So things are these two types of losses. Basically, the gist is that the net capital losses will expire. So if any of these, if the write-down of any of these things, any of these four things, will result in a net capital loss, that capital loss is going to be basically gone. We can't really use it, which kind of sucks. Whereas a non-capital loss is fine. You can sort of use it in the future years and all that stuff, okay? So that's why I'm sort of like differentiating between the net capital loss and the non-capital loss and stuff like that. But we've got this. So now we'll go over depreciable property. So for depreciable property, if the UCC, so the undepreciated capital cost, is greater than the fair value of the asset, then we have a non-capital loss. This is going to be a terminal loss, okay? Also, another thing to note is that this UCC is after deducting the current year CCA. So it's not like UCC, beginning of the year. It's probably like UCC, at like the date of acquisition of control, right? Like UCC in January 1 is going to be like probably higher because you have to like deduct CC and all that stuff. Blah, blah, whatever. Anyway, so the difference between UCC and fair value, if there is this sort of like UCC is bigger than fair value, that difference is going to be the CCA, and that is going to be included in the terminal loss. And since it's CCA, we know that, CCA, every time that you every time that you deduce, that you that you reduce CCA, that you like use CCA, that stuff affects the UCC. So basically this will reduce the UCC by the CCA amount, and then the original cost of that property will stay the same though. We're gonna go over an example now. Okay, let's say that we've got a furniture. It's got a UCC of $50,000, a fair value of $40,000, and a cost of $45,000. Okay, so one thing that I don't really understand, I guess, is why we're using the UCC and not the, why we're using the ACB and not the, wait, what? Is it ACB? Yeah. Why we're using the UCC instead of the ACB? Like, basically, you know how the rule of this thing is basically to write it all down to fair value? So if this is the fair value, and this is sort of like what we want the final answer to be, wouldn't it be like if cost is bigger than the fair value, then you would reduce it from 45 to 40? But their rule is that it's UCC to fair value? Hold up. I don't know if I did something wrong, because why would the cost be smaller than the UCC? Okay. Let's just pretend that this says 55K. 55K. Okay. So let's say we've got a cost of 55K, blah blah blah, whatever. In this case, the undepreciated capital cost is bigger than the fair value. And basically, it's like right now we've got this listed undepreciated capital cost. That's like sort of like the current sort of value of it, I guess. Is it just the tax value? We want to reduce the tax value? Okay, I think the thing. Okay, let's say we have the UCC over here, 50K, and we have the fair value over here of 40K, and we're like, whoa, the UCC is bigger than the fair value, and it's like, it's actually this entire, what is this, furniture? Furniture isn't worth that much. It's only worth $40,000. So we gotta reduce this amount, bro. Like, we gotta reduce it down to $40,000. Okay? Now you might be wondering, why are we using the UCC as the higher amount instead of the cost? Why don't we do cost of 55K? And it's like, oh, this one's bigger than this. So blah, blah. So the thing is, I think we're basically looking at the tax amount. So we want to change, or we want to like edit the tax amounts. When it comes to tax, we don't really look at the cost for these depreciable stuff. It's always UCC because that's what we use to calculate CCA and stuff like that. So, and even in the above things over here, so for inventory, there is no UCC. It's only the cost, so that's fine. For AR, it's only the cost, so that's fine. So, it's basically just, we compare the tax value to the fair value, and if that tax value is bigger, then it's like, then there's like a loss, okay? So in this case, in this case, 50K is bigger than the 40K, so you recognize a loss, and so we're gonna write this thing down to the fair value. Oh, right, and also the loss of the 10K, so this loss of 10K is CCA. So if we were to do this thing out, we would have our beginning UCC of $50,000 over here, and then less than UCC of 10K over here, and this gives us our new UCC of $40,000. And beautiful, this new UCC is equal to our fair value, so we are happy. Okay, so the UCC goes down, but the ACB has no change because we're only editing the CCA, which affects the UCC. So many letters, oh my god. Okay. Original ACB stays. Okay, that's fine. Final one, we have non-depreciable property. It's only 19 minutes. Okay. We have non-depreciable property. In this case, the sort of tax for non-depreciable property, there is no UCC because it doesn't get depreciated. There's no CCA and all that stuff. So it's just the ACB is used. So if in this case, if the ACB is bigger than the fair value, so if we have the stuff listed on our books at a higher amount than we can actually list it for, we can sell it for, I mean, then we would have to reduce our value. So we reduce this fair value, and this difference is, whereas before all of the losses that we found were all, they're all business loss or it's non-capital and all that stuff. This was CCA. CCA is a business loss, so that's also non-capital. all that stuff, this non-depreciable property is actually a net capital loss. This is actually a capital loss because it's like we're selling the 3B, like we're selling like an actual capital property and stuff like that. So what this means is that this reduces our ACB. Wait, what? Okay, no, it doesn't. This is sort of like the formula that we're doing. So the difference between the ACB and the fair value is going to be the net capital loss, and we're going to reduce that ACB to fair value. I'll write that down, ACB to fair value. And another thing is, so the big deal about this net capital loss is that it can't be carried forward, right? Also, I don't think this is right. I wrote can only do back, but I think this is wrong. But anyway, this thing can't be carried forward. So it's just sort of like goes away. Like it's just like, oh my God, we have this loss on this property. Let's say we've got like this land that was like, I don't know, originally, like we have it listed on our books at like 100K, but they're telling us the fair value is actually 10K. And it's like, wow, that's a loss of 10K. And this loss could potentially reduce our taxable capital gains and like our income and, you know, our taxes, etc. But the government's like, nope, you can't do that. This is not an allowed loss. You cannot carry this forward. Blah, blah, blah. Oh, my bad. Okay, you can't carry it forward. Okay, whatever. Anyway, this really sucks, okay? Which is why we've got this new sort of rule where you can elect to recognize the gain on other property to use a loss. This is a lot more confusing, so I'm going to make another, I think, actually, I'll do it right now. Yeah, whatever, it doesn't really matter. But, okay, before I do that, though, I'm going to do, like, a little recap. Do I have anything else? Oh, there's more. Oh my God, there's more. Should I do this first? Okay. Okay, this video is going to be long, then. There's nothing I can do about it. It's a bit of tragedy, but it's fine. Okay. So, over here, I just have, like, a recap table. We have each of the types, so I have inventory, AR, depreciable property, and non-depreciable property, and like a rule associated with each of them. So basically, if NRV is less than the cost, then that difference between those two would be business loss. And this loss type is a non-capital loss. This has no effect on the UCC, but it affects the ACB and reduces it to the NRV. With AR, if there's any uncollectible amounts, that one counts as BDE. This is a business loss, so it's a non-capital loss. Again, no effect on UCC because it's not like a depreciable thing. And again, the ACB gets reduced to the NRV. Next, we have depreciable property. So for this one, if the UCC is greater than the fair market value, then the difference between that is a non-capital loss. Oh, actually, I guess I should have written it down as like list as CCA. Listed as CCA. And the CCA is a non-capital loss. It's a business loss. CCA is a business loss, so it's like a non-capital loss. So one thing that happens is since this is CCA, what happens is the UCC decreases. Oh yes, your UCC decreases with the decrease of the CCA. Like I mean with the addition of CCA, I guess. Another one is for a depreciable property, the ACB stays the same. Why is that? Because over here we sort of affected. We've got the ACB reduces to the NRV. Over here again, the ACB reduces to the NRV. And here it's like the UCC sort of reduces to the NRV, right? Because we sort of reduced it by the difference between those two. So now the UCC is going to equal the fair market value, which is also fair market value is the same thing as NRV. I don't know why if I say that differently. But anyway, final things, non-depreciable property. So in this case, if the ACB is bigger than the fair value, then there's going to be a net capital loss. Again, different from all these non-capital losses, this is now a net capital loss. This stuff expires, so we'd want to use it now. And we would want to use an election basically to use it now, okay? There's no effect on UCC because it's non-depreciable, but the ACB decreases. Cool. I think this is like an example that I have. I don't know how. I don't know if I want to go over this. Okay, I'll just go over like really quickly. So, okay, so, oh, right, okay. So one thing is, sometimes they'll ask you for the tax value of assets. The tax value of assets, it's usually UCC, and if it's not, like if there is no UCC, then it's going to be the ACB. So if it's like a non-depreciable thing, it's going to be the ACB. Cool. Another thing is you're going to have to also include any write-downs that you do, and like stuff like that. So, what we have right now is we have a couple of assets over here: land, building, furniture, computer, blah blah blah. We have a couple of costs: UCC, fair market value, and what I've written down here is the type of asset it is. So land is not depreciable, building, furniture, and computer are all depreciable assets. Inventory is inventory. Marketable securities is a non-depreciable asset, and incorporation slash organization cost is a depreciable asset. So basically each of these things have rules, so you can use this little rule chart to find out what the rule is. So in this case, we either have a CCA or a business loss, which would go into non-capital cost, non-capital loss, or we would have a capital loss, okay? So over here, in this case, we're just going to go through everything. Number one, fair market value is bigger than the cost, so there's no loss. Number two, we have a UCC, so we're going to use this. Fair market value is bigger than the UCC, so we're good. Number three, fair market value is smaller than the UCC. So we're going to have to reduce this UCC to the fair market value. So it's going to be a CCA of $15. Computer, fair market value is bigger than the UCC, so we're good. Inventory, fair market value is less than the cost, so we're going to have a decrease of 3K. And this is going to be a decrease. This is like a write-down of inventory, so that's like a business loss. Again, non-capital. Over here, marketable securities. Fair market value is 10, but the cost 24. That's a decrease. Negative 14. This bad boy is a capital loss, guys. Why? Because this is a capital asset, I think. Not always sure what the specific rules are, but it's non-depreciable, so it would be a capital loss. Final thing, we have a fair market value of 0.5, and the UCC is 1, so you have to reduce it by 0.5. This is a depreciable assets, and this is CCA. And in this case, this is all that stuff. So over here, if we want to look at the tax values of each of these things, the tax value is basically going to be the UCC, and if there's no UCC, then it's going to be the cost. So it's going to be this guy over here. This guy's a UCC, so it's 90. This guy has a UCC of 65, but remember that we reduced that UCC by 15. So now the now the tax thing, it moved from 65 to 50, so now it's 50. This guy over here, it's UCC of 6. This guy over here, it would have been the cost of 55, but remember we wrote down that 55 to 52 because it's like a write down of inventory. So now move down to 52. For the marketable securities, this one would be cost 24, but we wrote it down by 14. So now it's going to be 10. And then the last one, first we start off with a UCC of 1, but again we wrote it down again, so it's going to go to 0.5. So yeah. So basically, I guess another way to think of it is if there's like a write down, and it's always going to be a write down of the fair market value, so just write down the fair market value. So this one was 50, 52, 10, 0.5, and those are all the fair market values. Because whenever you're doing write downs, it's always writing down the fair market value, okay? You're always writing down either cost or the UCC to that amount, so that's the amount you're going to have to use, okay? Coolio, so this is basically just calculating tax values, because I didn't really understand what a tax value was. Okay, this is a lot, and right now there's the election to recognize accrued gains. I don't know, this might be a big topic. I'll try to do it within 5 minutes, I guess. Okay, so remember, we're going to go back over here. Remember that if we have a non-depreciable property and we have this difference over here, this is the net capital loss that would expire, and it's like, oh my god, we can never use them. Well, guess what? We can kind of use them if we sort of do an election, okay? So there's this election that we can do to recognize accrued gains, okay? It's like a new cool thing that we can do. So for this, let's say that we have the situation over here. So we've got this non-depreciable property, which is this property over here, the one that we're talking about over here to the left, where the ACB is bigger than the fair market value. Let's go back. This is so slow. Over here, the fair market value is $80,000 and the cost is 100K. So it's like we're gonna have to write this down from 100 to 80. So that's a loss of $20,000, and this is a net capital loss that is going to expire. So what we can do is we can sort of elect to recognize it if we have an accrued gain from another asset. So if we have another asset, another capital asset, it could be either depreciable or non-depreciable. For this example, for this first example, we're going to assume that it's a non-depreciable asset. But let's say this is a non-depreciable asset. Let's say this is an investment. We have this investment. Fair market value is $90,000. The cost is $30,000. So basically, the fair market value is bigger than the 30. So it's basically like a little gain of $60,000. But remember, we don't really recognize these gains until the future when we sell them. Okay? Okay, that's what we would normally do. Right now, the only thing that we recognize is this loss. We recognize this loss, but remember, it'll expire. This gain over here, normally we cannot recognize this gain of 60K because we can only recognize that stuff when we actually sell the thing. Which is why this election is kind of neat, because it makes us able, it gives us the ability to recognize a bit of that gain, or even like the entire gain, right now instead of recognizing the future. And what that would do is you can use this gain on this asset, on this really cool high gain asset, to offset this loss that we would have been like expired and like gone away. Okay? And what this mean, it would mean that right now we would use up this capital losses, and in the future we could recognize a lower sort of capital gain because we've already recognized a capital gain on this asset. Okay? Probably won't make sense right now, but I think I sort of do some stuff here. Did I? I didn't? That kind of sucks. Oh, wait, no, I did. Okay. So, let's start off with, so we've got this sort of situation, we've got this investment that's got like a, sort of like an accrued gain, but we're going to elect to recognize that accrued gain. So what I'm going to do is I'm going to be like, okay, what? Okay, right, so basically, the gain that we get from number 1 is a fair market value minus the cost, which was 90 minus 30, which is 60K. So this is basically the accrued gain that we have. So our goal, what we're going to be doing is we're going to be bumping up the ACB of A, so of this first guy, to its fair market value to recognize a gain now and a lower gain later. So it's a bit confusing, but let's do it slowly. So first of all, we want to create a taxable capital gain of $20,000. Why is this? Because if we go up to the that net capital loss was $20,000. Okay, like that's the loss. This $20,000 is the one that's going to expire, that's going to be going away. And like, so what we want a gain to sort of offset this. So we're going to create a taxable capital gain of $20,000. And if it's a taxable capital gain, since this stuff is like since the capital gain is 1/2 taxable, that's a capital gain of $40,000. So basically what we want is we are going to want this elected amount of investment minus the ACB of investment to equal 40K. This investment over here is that thing at the very beginning, okay? So the thing at the very beginning, it has a fair market value of $90,090 and a cost of 30. But what we're going to do is we're going to elect an amount instead of using the fair market value of $90,000. We're going to say, okay, let's use a different sort of number, and we'll use a number so that this minus this equals $40,000. So we have the ACB of the investment of $30,000, and we have the 40K of the capital gain. So that would mean that our elected amount is equal to $70,000. So this elected amount is basically like what we sort of want this sort of like the fair market value of the thing to be. Okay, so this is sort of like the deemed disposition price for the land. So it's as if, okay, so, oh my God, it makes sense. Okay, it makes sense. Okay, oh my God, okay. So you know how normally, I did this, I said it like 300 times, but normally right now we cannot, like, normally we can't recognize this gain because we can only recognize the gain if we sell this thing, right? Right? So over here, since we're like sort of doing this whole election, it's as if we're electing to like sort of selling this thingy. So that's why it's a deemed disposition price. It's as if we're selling this land and it's like, oh, what are we selling this land for? And it's like, oh, we're selling it for $70,000. So now this would lead to a taxable capital gain of $70,000 because that's like our deemed proceeds. It's like, oh my God, how much are we getting for the sale of this land? $70,000 minus the original cost of the land, which was $30,000, and this equals 40K, right? This is going to be like our capital gain. And to go from the capital gain to the taxable capital gain, you divide it by 2. So that is $20,000 of the capital gain. And this $20,000 of taxable capital gain is going to offset this net capital loss. Where are we? This net capital loss that would expire, okay? That's the purpose of this entire thing, okay? I think that's it here. Is there something else that I want to go over? I mean, like, yeah. Now you might be thinking, okay, what is the purpose of this? What is the purpose of using this, this gain right now? Like, I get it, you're using the loss, but what's the purpose of it? Is the fact that the ACB of the land is going to be increasing. It's no longer 30,000. It's going to be now 70,000. Okay? So in the future, if the land is sold, there's going to be a lower taxable capital gain. So we're going to look at two situations very quickly. So without electing, and if we had sort of just like let that capital loss of 20K expire and just like leave it alone, what we would have done in the future when we sell the land is we would get a proceed of 100K and ACB of 30K, capital gain of 70, taxable capital gain of $35,000. It's normal, it's like a normal sale of the land. But with the election, because of the fact that we've done this election, let's say we're still selling it at a proceed of $100,000. By the way, this $100,000 I just sort of made up for this example. But we're selling it at $100,000, but in this case, the ACB is now 70K. Because with the election, this increases our ACB of the land. So now the capital gain is $30,000 and the taxable capital gain is 15K. So in the first case, over here, in the beginning, when we have that net capital loss, we sort of ignore it. We get no like benefit from it, I guess. Like no, we pay no taxes on that stuff. But in this case, we sort of use that capital loss, that net capital loss, to sort of reduce our future capital gains. Okay, to sort of show that it's sort of like equal, I guess. Let's go over here. Here is the proceeds. Here is the cost. 30K, 100, ACB new of 70K. So basically what happens is in the very beginning, we recognize a capital gain between these two numbers. Okay, so this is in like, when we first do the acquisition of control stuff. And then now when we sell the land, we do this capital gain between this proceed and the new ACB. And this one will get you a taxable capital gain. And over here, the taxable capital gain equals 0. So whereas before, you'd have to calculate a whole taxable capital gain on this entire 100 minus 30. In this case, if you do the election, this part over here, you don't have to pay taxes on this. You only pay taxes on this amount, which is super cool, and which is why we have this whole election, okay? Now, one thing to note is that if we do this bumping up of ACB for non-depreciable properties, so remember what we did here is that we bumped this ACB from 30K to 70K. Also, another thing is ACV is basically the same thing as cost. So we sort of increase that ACV for that property. So the first example, we increase the ACV of a investment, of like an equity investment, whatever, like a stock, and that stuff is non-depreciable, okay? So there's no like CCA, UCC stuff and all that stuff. But if we do this type of stuff, if we decide to recognize a taxable capital gain to sort of like reduce that, to sort of like use that net capital loss, if you sort of do that thing on a depreciable asset, you might have to worry about recapture, okay? I tried to sort of do like some math to figure out why there's recapture. I'm not sure if I got it fully. I wasn't fully understanding it, but why would there be recapture? Okay, let's say this example over here, let's say we have this depreciable property over A, the depreciable property A. It's got a fair market value of 90K, cost of 30K. It's the same as before, by the way. We have a land with a fair market value of 8 and ACV of 100, same as before. Now, since this thing is depreciable, let's say that this thing has a UCC of $20,000. Okay. So now, again, if we look at the stuff, this thing over here would lead to a capital loss of, I hate how this thing lags, of $20,000. So we would need a taxable capital gain of $40,000 from the deemed disposition of this guy over here. Okay? So we make the property we sort of, oh, also another thing is the elected price is basically like a price that we sort of give. We choose this number and we're like, this is sort of the price that we're going to use for the new ACB or for the new stuff, whatever, okay? So property A, so the EA, the elected amount minus the ACB has to equal to 40. ACB is still 30, so elected amount comes to $70. This case, since property A is a depreciable thingy, there's going to be there might be recapture on the sale or transfer of A. Remember, this entire thing is we're sort of recognizing a gain, which means that it's sort of like a deemed disposition. Disposition. Okay? So let's say that we start off with a UCC of $20,000 and we have a deemed disposition. We have a cost of $30 and the proceeds of 70. And where are we getting this proceed of 70? From the elected amount, by the way. From the selected amount of 70, because that's like sort of, we're pretending that we're selling it at this amount. So it's going to be $30, because that's like the lower amount. So basically this gets us to a negative balance of 10K. So say 10K of recapture. And recapture, remember, it's added to business income. Business income. So this would increase the amount of taxes that we would have to pay. So kind of sucky thing is that if we have any non-capital losses, those non-capital losses, you might have to, like, since non-capital losses are sort of like, go against any like gains, income that you have, this 10K over here would sort of use up a bit of the non-capital loss. And we're like, yo, I don't want to use up that non-capital loss. Like, I want to be able to use the non-capital loss for like other issues, not this recapture, which is like literally like a fake disposition. It's like a fake sale, right? So yeah, so that's sort of like a little issue that you might have. One thing is, so the reason, and the whole reason that we have this recapture is because it's a deemed disposition. We're pretending that we're selling this asset. So at the sale, we do this whole process, right? So it's like minus 10K, blah, blah, blah. Whereas if we didn't do this disposition, if we didn't do this deemed disposition at all, in that case, there wouldn't even be the sort of like less cost of proceeds. I don't want to X this because now it looks like I did something wrong. Cool. So basically, if we decided not to sort of elect on this depreciable property, then it would be like we just wouldn't have this what is this thing called? This recapture. And remember, one thing about recapture, one thing about non-capital losses is that this thing is reduced against all sources of income. So this guy's sort of like really cool, and I don't want to use this really cool guy on something that's kind of lame, right? On like a fake disposition. So I'm just gonna like not even do this. I'm just gonna not elect. Okay. So that is basically all of this stuff. That's basically the entire acquisition of control.